Hey everybody, this is Justin Bogard, and this is the Real Estate Note Investing Be the Bank Meetup. Hope everyone is doing fantastic tonight. A lot of you have blown up the chat board and have said so. That's good to hear. So this is me. I am your host. Here's my email, justin@brightpathnotes.com. And if anybody can't hear me or if the mic isn't picking me up very well, please feel free to chime in the chat box. Let me know if it's not picking me up very well. And I will try to adjust my settings to help that. So, big fat disclaimer here, surprise, surprise, I'm not an attorney, I'm not a tax consultant, and I am not a financial advisor. I am a note investor, and that's what I do. So let's just start off. Oh, John, yeah, you'll get a copy of the meeting. Let's see, I will be able to email that to you. If you're on our email distribution list, you'll definitely get it. If you're not, you can go to our Facebook page or our Facebook group that we have, Real Estate Note Investing, and there'll be a copy there. And also I'll make sure that I email a copy out to everyone that's on the call tonight. Just fine. So this event wouldn't happen without some sponsorship. So there's a lot of effort that goes into these meetups. This is probably our third year doing them right now for the note meetups here in Indianapolis. So one of our sponsors here is, surprise, surprise, it's my company, Bright Path Notes. So that's me, Justin, at brightpathnotes.com. So we sponsor the meetup and we offer the deal flow. So our slogan is, we've got the deal flow to make your cash flow. That's our slogan. So yeah, we have note deals on our website, and we also find inventory for you. Cyria is another sponsor for us. They are our real estate educational company. Vicki Perry there, you can see her number. She's local here to Indianapolis. It's 317-670-8491. You can also reach her at executive-director@cyria.club. And then the space that we usually come to for the live meetups is here at a facility called Launch Fishers in Indiana. It's in Fishers, Indiana. And it's like any other shared workspace. It's really cool. They got a nice big theater room, which I'm at right now. And this is where we have our live meetups when we have them live. And I personally am a member here as well. So I pay about, I think it's just under $100 a month to have a membership here. So you get access to all of their things. They have a very high speed internet up and down. They have private conference rooms that you can reserve. They have phone rooms you can reserve. They have this theater room, which you can reserve as well. You can meet clients here. They have a coffee shop in-house, free water. Isn't that great? Bottled water. So we love it here. Libby Hales, 317-537-7380. Libby at launchfishers.com is who you would reach out to if you're interested in touring the facility and kind of checking it out. And then our new sponsor this month is a previous sponsor in the past who decided to come back because they were having so much fun. And they are our due diligence sponsor. So it's Dickie Baldwin. That's 936-447-4170. D Baldwin at baldwinadvisorygroup.com. So what is due diligence? Due diligence is getting things like appraisals, inspections, skip tracing, title reports, and things like that. That's who we primarily use them to do all of our title reports and our inspections and our appraisals and stuff. So Dickie's a real good guy. He's very responsive. I highly recommend him, and I think a lot of you have used him before as well. So Cyria, the Central Indiana Real Estate Investors Association, they are our local club here. Like I said, they're also a sponsor, and a lot of you are a Cyria member that are on the call tonight. And so don't forget, they have social media channels. They have a Facebook page at Indiana Cyria. They have a LinkedIn page, which is at Cyria, and then all that spelled out there. And the Instagram page they have is Cyria Real Estate Investing with the underscores in between there. That's how you can find them on Instagram. Don't forget, they have a YouTube channel. They are blowing things up with videos all the time. Tons of people that are really good in our group. A lot of vendors and a lot of experts are posting videos and helping you guys out. So Cyria is a great organization to be a part of, especially if you're trying to get into real estate. We'd like you to, we're biased. We want you to be note investors, but we all can't be note investors, right? We want other things to do. So Cyria is a great place to land for that. Those of you that understand what PHP credits are, here is your link to log into for tonight. It's the same link as always, http://bit.ly/Cyria notes. Log into that, use your smartphone, and you can get into that. Let's see. Oh, Tom Manuel. He said, I just used Dickie Baldwin just this past week. Great job, Tom. Way to send some business Dickie's way. He's a great guy. He gets back to you. He's very responsive. He stays on top of it, which I love. So Dickie's a real good guy. He's out of Texas. He's based in Texas, but he has a ton of connections and stuff. He's been in the business for quite some time. So fast forward to the Two Wealth Show. If you guys didn't know, I am a podcast host, kind of a co-host. My co-host is Elizabeth Mayora, aka Super E, as you see, Two Wealth with Justin Bogart and Super E. You can download us on all the podcast directories that you can think of. These are just a small handful of the ones that we have: TuneIn, Stitcher, Google Play, Apple Podcasts, Spotify, iHeartRadio, so on and so forth. They're all on there. We actually have a YouTube channel as well for Bright Path Notes, and we post the video cast of us doing a podcast on there as well, so you can watch the video of it as well. We try to keep the episodes between about 20 to 25 minutes long. This is our second season doing it, so come check us out. Download, subscribe to our, I guess call it subscribe to our channel. We'd love that. So today's agenda, finally getting to it, right? We're already 10 minutes into it. We're going to be going over the note basics, which we always do. We're going to do what's called the 10-year model. This is a model that I kind of made up to show people what it's like to build wealth inside a note portfolio. And then the last is kind of a case study with some gap funding. And so we're going to highlight that. So today's sit back, relax, and get in the driver's seat and learn how to build some wealth. Before we get into that, don't forget over on your Zoom controls, if you're on a desktop or on a phone or tablet, I'm not sure how it looks on your screen, but if you're on a desktop, there is a Q&A button that's for you to fill out if you have questions during the presentation. They'll show up in a queue over here for me, and I'll be able to see those questions, and I'll be able to answer them live, or I can type them in as well for you. There's also a chat box if you want to chat to me and just make a comment or whatever. That's perfectly fine too. I got both windows open, so I try to capture all that I can. And if anybody has a question towards the end as well, we can always unmute you and you can jump on and you can get on the call. Like I said, this is recording right now, and so this recording will be available to all of you afterwards, more than likely tomorrow. So we'll make sure that you get a copy of that as well. So if you have any questions, use the Q&A button, fill out your question. If you can't find it, look at your Zoom controls, and it's somewhere on those Zoom controls. Like I said, it's different for each computer or each tablet or smartphone that you are on. So check out the chat box here. Looks like we're all caught up on our questions and comments. And so without further ado, let's kind of roll right back into it. So the note basics, this is what I like to start out with. Most people, when you talk about note investing, they don't really understand what it is until you kind of visually walk them through the basics of how a note is created and then how a note investor gets involved and buys these assets. So for those of you that have never been in the note space before or even know what I'm talking about, I'm just curious today. So we buy the mortgage on the house. We don't buy the actual house, if that makes sense. So we don't invest in the real property. We really invest in the borrower or the debt on the property. And this allows us to be the bank, which is pretty neat. You can be extremely passive or you can be a little bit active as well. They do have non-performing loans out there that you can purchase. So you would be getting a property, let's say that's $100,000 and the note balance is maybe $80,000, and then you might pay $40,000 for that note. Just throwing out a scenario, okay? So that means you would pay $40,000 for this note that's non-performing, and then the house is worth $100,000. So you have a lot of protection there. There's a lot of cool things you can do. We won't get into non-performing in today's meetup, but we have in past meetups as well that you can probably look up. Glitch, here we go. All right. So when you buy real estate, you got a buyer and a seller, right? They agree to some terms to a house. Whatever that number is what they agree to. That's what they agree the value is. And so the seller has the deed to the house, right? And so at closing, they convey that deed from the buyer to the seller. All right, that buyer will put down some sort of down payment, and then they're going to need some help funding the rest of the money, right? They're going to go to a bank traditionally, and a bank's going to loan them the money in the form of a note and mortgage is what you would be most familiar with. That note and mortgage is now the bank's note. So they hold the paper, and the buyer or the borrower now is holding the deed, right? You see that? So the bank's security is that real property. So once again, the bank owns the note, not the house, and the buyer owns the house, and they hold that deed, right? A little bit different than having a car. When you have a car, you go to the dealership and you buy the car, and if you don't pay cash for it, if you need lending help, The lender is holding title to it, and you're making your payments until the last payment, and then they transfer the title over to you, right? So I'm reading a question here. Tony says, for my lease option to buy deals, I have a holding company and a management company. I'm creating a JV LLC with a partner solely to buy notes. Do we need both a holding company and a management company, or is there no need for the management company when using a third-party servicing? Tony, that's a very good question, and we'll have to answer that offline because I think we're going to get into the weeds on that. But you can reach out to me at justin@brightpathnotes.com. That's Justin, Justin, at brightpathnotes.com, and we can have kind of a side conversation with that. I can tell that that's going to get into the weeds a little bit. Maybe we'll save it towards the end. How about that? Remind me again, Tony. We'll try to answer that towards the end. So back to the note basics. So you have the homeowner. The bank owns the debt, right? The homeowner is on the deed. And so this is what happens. We got Mr. or Mrs. Investor that shows up. That could be an LLC. That could be a retirement account. Could be a solo 4K, self-directed IRA. Could be an individual. Could be a trust. Whatever entity has a lump sum of money that can go buy this note, and they'll buy it for a discount. They will pay that said bank, and then the paper will transfer over to the investor. Notice how the deed still stayed with the borrower. And that's what's key about this. We'll watch that again. That's what's key right there. So the investor is investing in the note, not the house, right? And so guess what? The monthly payments now go to the investor instead of the bank. So they were going to the bank, and now they're just going to the investor. So whatever that payment is, let's say it's $800, they were paying the bank, that same $800 payment now just transfers over to the investor. And that's passive cash flow. Any questions about the note basics, feel free to chime in, and we will try and get those answered. So the 10-year model. So this is something that I don't think I've seen anybody talk about as far as building wealth within a small portfolio and building your portfolio with just leveraging your own loans and letting this stuff sit and grow. And I'm going to walk through visually of how this looks, okay? So if you imagine that you have $200,000 and you're wanting to invest it, you have a lot of options. You can probably buy maybe one medium to medium high-end fix and flip in a working class area. Maybe you can buy a few rentals with that. But what if you just bought notes with it, and specifically performing loans with it, okay? And we're going to show you how you can set it and forget it and let this sucker grow and watch the exponential growth that happens within this portfolio. So all things being equal, we can throw different numbers and have different loans out there that can get very confusing, but we're trying to keep things simple and concise just so we can see how the growth works. And so we're saying all things equal. So we're pretending and assuming that we're going to buy the exact same type of loan every time we need to buy a loan. And we're going to replicate this over and over and over again. You're going to see the trend of how this happens. So for all intents and purposes, we're going to imagine we have a borrower. That borrower owes $45,000 on the house. Their interest rate, I realize that's an odd interest rate. I just did it for the math to work out a little easier. So let's say they're paying an 8% interest rate, and their monthly payment is $386.01 a month, and their term on this loan is going to be for 20 years, okay? So that's a $45,000 that they owe the bank. They're paying an 8% interest rate. Their monthly payment, just principal and interest, is $386.01, and they're paying that for 20 years, okay? So that's the loan that we're going after. And we're going to say all things being equal, we're going to just concentrate like that's the type of loan that we're buying. With me so far? All right. So with that $200,000 investment, we're going to purchase 5 of these loans, okay? We're going to pay $40,000 per loan. Now, granted, every loan's different. Every discount is different. Every loan, like I said, we're trying to make things, the math easy and easy to follow. So we're just going to work with very round numbers, and we're going to replicate this a few times, okay? So there's our total investment of $200,000. So what happens here? You get monthly cash flow because you're buying performing loans, okay? You also have discount unpaid principal balance. That's what UPB means. I know I do acronyms a lot, and I'm sorry. Unpaid principal balance. We have a $45,000 loan. and we paid $40,000 for it. Does that make sense? So there's a $5,000 gap there of, we'll call it some phantom income or some phantom equity built in there. And so the idea is to grow and buy more. And you're going to see how this is going to work. So this will be a great play in somebody's retirement account. This is where it really shines. So how many of you have seen an amortization schedule and really understand it? A few of you probably have. I know when you look at it, it's kind of concerning that you wish you were the bank on every deal when you see this stuff. So these first payments are very heavily favored in the interest column. And so this is what we're going to look at here. So you see that $386.01 payment. The very first line in month one, it says $73 of principal and $312 of that is interest. So that unpaid balance on the far right goes down from $45,000 by $73.22 for that payment, right? So the borrower still owes $44,926.78. You with me so far? And every month, that principal amount that they pay within their $386 payment just goes up a little bit. And that interest amount goes down a little bit. So when you get to about 180 months on a, let's just pretend like it was a 30-year mortgage, that's about when it would be somewhat equal as far as half the payment will be principal and half the payment would be interest. Does that make sense? So obviously the front half of a loan is much more valuable to a bank because it's very interest heavy, right? So that's what we want to keep in mind when we're thinking about the amortization schedule when we're going through this 10-year model, okay? So all things being equal again, we just bought those 5 loans, right? We had $200,000. We invested $40,000 each of those loans. So a total of 5 loans. We spent $200,000 and we have $386.01 payments coming in 5 times, right? So you can do the math pretty easily. That's about $1,900. We'll call it $2,000 coming in monthly of just passive income, right? Cash flow. So how long do you think it's going to take for you to build up enough money to buy another $45,000 loan, getting a discount of $40,000? So we'll call it a $40,000 loan. So how long do you think it'll take to build up and do another loan? Well, I get a drink of water. By the way, if my mic goes out, sorry, let me know. Oh, I knew our physics guy would chime in quickly. Edward, 21 months. I believe that's correct. 21 months. Edward, you get the gold star. Thank you, Linda. You also got the correct answer. So we just got $40,531.05, right? So now what do we do? We have enough to buy a 6th loan. Remember, all things being equal, there's nuances here that can be changed and slightly different, but we're trying to make the model easy to follow. So now we've got a 6th loan. So less than 2 years, we're able to accumulate enough cash in our bank to acquire a 6th loan. So now we become $45,000 wealthy in our net worth, right? So now we got 6 loans coming in, giving us cash flow. And that cash flow now has raised to $2,300. So we're talking about month 22 and onward. So now how long is it going to take to build up enough money? It's going to take, Edward's on it again, another 18 months, 17, 18 months to build up enough cash to buy another loan. And you're gonna see this a couple more times. So we got now $41,000 of cash flow. And this is you not touching it. This is just setting it and forgetting it and letting it grow, right? This is just a simple model. Now we buy our 7th loan. Same thing happens again. Now we got 7 loans coming in with the same cash flow coming in every month. So now we're back up to $2,700 of cash flow. So we did 21 months in the first stretch till we got the 6th loan, 18 months to the next one. And now this one's only going to take about 16 months. So we got, 2, 3.5, about 3.5, 4 years now we're into this, and we've got 7 loans when we started out with 5 loans, right? Get our 8th loan. $40,000. So this is the trend that happens. I need to move my camera here because I can't see my graph too well. All right, so this is the trend that happens. If this is too dark in the background, I apologize. But basically, what you're looking at here is Here is the amount of cash flow coming in every month in just 1,000 increments. So remember, we were a little bit below $1,900, about $1,930. And then the 21 months, you see the 21 right here, we grew $386 a month, and it only took 18 more months to grow another $386. And see how these blue dots get shorter and they get closer together? So that's this exponential kind of trend that's going up and up and up and up. And you can imagine once you get to a certain point, it's going to continue to grow quicker and quicker and quicker. So this right here ends up being probably before 10 years. I guess I messed up in my graph. It didn't go to 120 months. I was trying to, but it didn't work out that way, I guess. So this up here, it looks like it gets to about $5,400 of cash flow coming in right at about closer to the 10-year mark. So you start well from $1,900 and then you get $5,400 of cash flow coming in a month, right? So we're going to look at a graph in a different manner. My screen blows up here. So this looks a little weird. It's like stair-stepped and then it descends, stair-steps and then descends. So this, what we're looking at, is the unpaid balance part of it. So this is what's neat about it as well. So you can see how much wealth you have created each time. So it starts off right because we have a $200,000 investment. There's our orange line going across. But remember, we don't have $200,000 of unpaid balance. We have $225,000 of unpaid balance, right? That's what the borrower owes. Doesn't matter if we bought it for $1, they still owe the entire amount because that's what they promised to pay, right? So that's why you're seeing a trend of the green lines every month going slightly down a little bit, because guess what? The borrower, like in the AM schedule, is paying down principal very little each time, right? And so you can see after the first 21 months, when we accumulated enough cash to go buy another loan, that it gets down close to the 200,000 marker, but not quite there. And then it jumps back up another $45,000 because that's the unpaid balance that we bought again. And that's why it goes down a little bit and then it jumps back up. That's the 7th loan that we bought. It goes back down and there's like the 8th loan. You can see it stair steps. And also the timeline of which it stair steps is getting smaller and smaller and smaller and smaller. So that gets us that exponential growth like that. So by the time we get to those, to the end of 10 years, you know, we got well over $500,000 of unpaid balance with all these loans. And we started off with $200,000. So the growth is pretty immense. There we go. My screen glitches a little bit here. So this is the cumulative cash and what I call in the bank. So this is if you're thinking about, you have a checking account. I'm sorry, my video is getting in the way here. I need to move around. So if you imagine your bank account getting all this cash flow coming in, that's what you're looking at month after month as it's growing at a rate of however many $386 payment loans that we have. And that's how quickly it will grow to $40,000. Now I realize the $40,000 marker is not showing in here, because when the math works out, by the time you get to 40,000, I'm already buying it and I have a little bit left over. So that's why you don't ever see it get to 40 on the graph, but it does happen. So right there at month, there's 21 right here and month 20 right here. So that's the time it transitioned. And same thing here, you're seeing it go up and up and up and up, all the cash flow. And then boom, it jumps back down because you've taken that cash and you've reinvested it each time. And again, the frequency, you see how the width gets shorter and shorter and shorter and shorter as time goes on. And eventually it only takes a few months here and there to get another loan, which is a really accelerated growth. So if I lost anybody so far, I apologize if these graphs didn't come out right. Let me know, chime in and ask some questions. Tom said, good thing you're using a Roth account. That's right. That's right. Like I said, all things being equal, just showing you what the trend is, is what we're kind of focusing on here after 10 years. So now let's look at it at this point where we're at the 10-year marker. So let me ask the question. How often do you guys think that loans will either refinance or they will pay off early via refinance or selling the home? Go ahead and chime in the chat box. How many years do you think is about average? And it could be countrywide, not just Indiana or certain types of loans. Okay. We got 6 years, 5 years, few years, 7 years. So the answer is, I believe the last time that I checked, the answer, the national average for when loans just pay off early is in between 7 and 9 years. I think tightly it's about 8, 9 years. So we're going to call it 10 years into this, okay? So 10 years into this, we're going to show these loans are paying off. And honestly, there's about a less than 1% chance that loans actually go to full maturity, meaning if it's a 20-year loan, it's probably not going to take 20 years to get to the payday, right? So with the time value of money theory, with note investing, your return is going to be a lot sweeter because you didn't wait 20 years to get your maturity. It was paid off in half the time, in 10 years. And so that your yield or your return on investment becomes a lot sweeter at that point because it gets paid off early. So that's why I like to buy longer and invest in longer loans as opposed to shorter term loans, because shorter term loans traditionally don't pay off because they just reach full maturity. So that's kind of my 2 cents on that. So if you imagine, and bear with me, this is where the math is going to get a little different. So those 5 loans that we bought initially at month 1 had a $45,000 unpaid balance, right? After 120 payments, assuming they didn't pay off early or have any missed payments or paid ahead, we're going to make all things equal. At 120 months after that payment, 121st month, they have $31,300 of principal left of balance on their loan. So we essentially have 31,300 times 5. We got 5 of these loans that we bought initially that basically are paying off at the same time. We're hypothetical here, right? So that amounts to 156,500, right? So that is an influx of cash coming in because of early payoffs for whatever reason. Now, some of them may go longer, some of them pay off shorter, but we're trying to make this model simple to understand and follow, right? My mouse at, here we go. So keep in mind, we have bought 14 loans. We have 14 loans in total, right, before this payoff that we've built up. So at the end of 120 months, we have built up enough money to where we could buy another loan, but we're going to pause and just kind of take a snapshot of where we're at, like at 10 years. So the cash flow alone from the loans 6 through 14, the ones we have created through this velocity model here, is creating a cash flow of $3,400, okay? We also have built up $40,000 in our bank of just cash flow at this point from buying loans. And then we've also got an influx of $156,500 of just payoff money. So remember that discount that we bought at the beginning? We had a $5,000 discount. So now it's paying off here at the end to where we're seeing that discount back to us. So all things considered, if you look at this now, we almost have our initial investment back after 10 years of sitting there. How neat is that? So if our total cash in our bank account is around $197,000, so the unpaid balance left over from loans 6 through 14 is $364,000 approximately. So that means the 7, 8, 9 loans there, that's how much unpaid balance is left on them. So that's initial wealth that's been created by letting these loans build up and blow up in your account. So now the total net worth, you're adding these two numbers together, is over $550,000 and starting off with a $200,000 investment. So that is the 10-year model that I kind of wanted to show and focus on. So let's kind of beat this up a little bit. Does anybody have any questions about this 10-year model that we went over? The total cash. How did you tackle it? Oh, the total cash. Gotcha. All right. So what we're assuming here is we've got those first 5 loans that we had, right? And we know that the national average is probably 7, 8, 9 years for somebody to pay off early. And we're just going to assume and be a little bit conservative that after 10 years, they just paid off early for whatever reason. They refied it or they sold the house, right? Or they came into money and they just paid off the debt. So the $31,300 for each loan, that's what the borrower owes at that point. After 120 months of them paying, they still owe $31,300. And we're just replicating that 4 more times because we have those 5 loans, right? That's where I came up with the $156,000 number. And then at the 120-month marker, we had also been building up cash flow to about $40,000. It just worked out to where right at 120 months that we had enough cash in the bank to buy another loan, but we didn't yet because I was just showing you and pausing at that point, if you will, and looking at where we're at with our wealth, okay? I hope, does that answer your question? Doreen? Sorry if I enunciated your name incorrectly. Cool, all right. Edward had a point in there. So he calculated this as a 14% average return there. Sorry, 10%, 7-year doubling time. Yeah, so what do you do at this point, right? You have this influx of cash. You have this wealth that's created for you. You have this cash flow coming in. You got this net worth, we'll call it 550, right? You have cash plus you have loans or assets, performing assets. So what can you do with this cash? Well, what we would like you to see is if you just put that back in the model and you just buy, 5 more loans and you just go after this again and again and again and let it build. And eventually you want to live off of it and you want to pull, let's say if you're getting in $6,000 a month in cash flow, you need $2,500 to live off of. Well, then obviously pull $2,500 out of it per month, and the remainder you're just letting it grow and build, right? So that's what's cool about this model. So it's just showing what you do if you don't do any. This is the bare minimum that you do. This is just set it and forget it. What most people end up doing is they don't like the idea of just setting it and forgetting it. They want to fuel the fire, right? They want to put more cash into it, the more of the retirement account, and keep throwing it in this fire. Just imagine every year you put in another $10,000, $20,000 of other income you want to put into your retirement or into this model. And this is going to grow even more and more and more. And you can get to $1 million pretty quickly, but it's by putting another $10,000 to $20,000 into these cash flows every year or every few months, whenever you're at that point. So that's pretty cool. So is there any more questions about the 10-year model? By the way, we're not going to go a full 2 hours if you've not been on one of our meetups before. We traditionally go about an hour, maybe an hour, 15 minutes. We just allot 2 hours of time because we get into some other discussions at the end of the meetup that you don't have to stay on for. It's just other people hang on a little bit. So, oh, thanks, Dave. Appreciate the shout out. All right, so I'm going to fast forward to, it's kind of a case study in motion. One of my friends needed some help or some advice on how to handle a situation with real estate, and I kind of just gave him a little bit of creative strategies. Some of you may be using this now that it's more advanced in real estate than others. But if you haven't, this is something that you should consider, and it can work in certain scenarios. So I just call it gap funding. It's kind of loosely what I call this creative deal. So in Indiana, we are a working class area, working class state in most areas, right? So this seller is pretty motivated to move, but they want the highest dollar they can get for that house, right? So they're looking to sell this house for $88,000, okay? The guy that I'm helping out, he has a lender. It's more like a private lender, not really like a bank. And so they got an appraisal for $78,000 on this house. And what the lender's criteria is they're only going to fund 75% of the appraised value of the house. Well, if a bank or somebody thinks it's worth 78, and we all know it's subject to somebody's opinion, right? If the bank is saying it's worth 78 and the seller wants 88, well, obviously this guy is theoretically overpaying for the house, right? If he wants the 88,000, the seller wants $88,000, right? So You have to get a little bit creative here and think outside the box. How can I make this work? Now, keeping in mind that this guy only has about $20,000, and he could fund the rest of this if he wanted to, but then he needs money to rehab this, because I think this is a 2-1 setup right now, and he wants to convert it to a 3-2 setup, because he's able to take some space in the attic, or he's able to add a little bit of an area here to give it some more square footage and some more bedrooms and bathrooms. And, he has rentals as well. So he already has, I think, has 1 or 2 people lined up that would be willing to purchase his home as well, which is going to work out for him very nicely. So what are his options here? He could pay the cash for the difference, right? The money that he has, but then what is he going to do for the rehab? He could go out and get another loan if he wanted to, but he wants to keep his debt as low as possible, right? So asking for seller financing and having a second mortgage on it is going to be a very strong play for him. So it makes him in a stronger position, because he can dictate the terms. And the seller has to go along with this too, right? So a seller is motivated to sell the house, and they say, look, my appraisal came in at $78,000. Like, I'm sorry that you want 88, but the bank says, or the lender says, or the appraisal says it's only worth $78,000. So who's going to pay more than that? If they really want it, I tell you what, if you provide the financing for me of the difference between what my lender will give me and this, then we can make a deal happen. So what happens is the person selling the home is more than happy to get a lump sum payment of about $60,000, and then have another $20,000 of just cash flow coming in on a small note. And of course, guess what? As the real estate investor, he's able to dictate the terms that heavily favor him. So it's a 0% interest loan, right? It happens more than you think. If you don't believe it, it happens more than you think. So the bank, let's call it the bank, the first mortgage is going to be for around 60. I think he changed the numbers on me. So it's 67,500. So that's 66% of the entire funding of the deal was for the first mortgage, and the second mortgage is $34,000. Now he has virtually no skin in the game, right? But this is what's cool about being creative. But now he can take his cash that he has and he can go rehab the house, right? And he can have these small payments. I don't know what the first mortgage, the underlying debt, I don't know what the numbers were. I want to say it was a low rate of 3 or 4% on the first mortgage, and he's having a 0% on the second mortgage. I'm not sure what we stretched it out to. I want to say it was probably 10 to 12 years on that. So anyways, the funding the whole house was only $87,500. Now, with this guy's knowledge of the area that he's going in, he's pretty familiar with what he can do and what this thing will be as an ARV. So he's total all in and zero cash out of pocket for $87,500. We'll call it $88,000, right? If anybody's lost so far, don't be afraid to chime in, because these things are not shown a whole lot in these case studies. They are now today because of the need for seller financing. But all right, lost my clicker there. Where are we at? So he estimates the rehab cost being $20,000 before going into it. He's saying the ARV, it sounds like one Dave Short's deal. Nice. He's saying the ARV is around $165,000. So just by making another bedroom and a bathroom in this area and just putting a few amenities in there, people are definitely going gangbusters and buying stuff, and they're appraising very high after these changes for $165,000. Okay. So this house, I didn't actually see this house, so it must have had some issues on the side that needed to be cleaned up, or when it was hoarded. So his break even is around $108,000. So if you imagine, what he's going to do is, our first idea is going to sell this with a wrap note. So those 2 mortgages that the guy has on the property, his underlying debt, he's going to wrap another mortgage around that, right, with seller financing. Where am I at here? Oops, back up a slide, sorry. Any questions? Laura asked, is seller financing legal? Absolutely, it's legal. Seller financing is very legal. There's nothing wrong with that. You don't have to be a special lender. Now, what is illegal is if you do too many seller financing deals in the same year. So the rule of thumb is 3. If you're doing more than 3 seller finance transactions in a year, that means that you are creating a loan. So the guy that is in this deal, he's not creating the loan. he's just paying the loan, right? The person that he's buying the house from is the lender, or the second lien lender, right? So you can do up to 3 transactions a year, and that's because of Dodd-Frank and the CFPB rules from 2014. So if you do more than 3 transactions a year, you are still able to make more loans, because we know a lot of people that make a ton of, or lend a lot of money and make a lot of loans with seller financing. So the way to get around that is to have a third-party underwriter get involved, to where there's a degree of separation from you and the deal. And then that's how you become compliant. The idea is really to make it fair for the borrower. You want to make sure they have the ability to repay. You don't want to stick somebody in there like in 2006 when they have a $50,000 income and they're buying a $500,000 house. The math is just not going to work with the debt to income. So an underwriter will look at a borrower situation. They won't really mind credit score as much. It won't be as important, but they'll focus on what is their income and what is their debt, and can they afford to make this payment and not put them at risk of being a default. And that's the idea of doing it. So if you ever go to foreclosure, and if a borrower ever has a lawsuit against you, you won't be looked at as a predatory lender. And that's kind of the idea behind it. So when we create loans, or if we help people create loans for them, we are always going through our underwriter and just underwriting them anyways, even if they don't have more than 3 transactions in a year. We just want to do it the right way, and we show people how to do it the right way. And what it does is it makes your loan more valuable if you sell it in the secondary market. And we always try to put things on a note mortgage if we can. This deal in particular is going to be a land contract that's wrapped around there. It just makes things a little bit less complicated, because when we go and sell the loan in the future, we'll be able to pay off all the underlying debt that's underneath it, and it'll be one loan. And we can also convert that land contract to a note and mortgage pretty easily. And we put that language in our contract as well. So with all that being said, let me look at the chat board here. Yes, the second mortgage on there was a 0% interest rate. This is what can happen with motivated sellers. If you give them the price that they want, they will very easily negotiate with you on terms. They're fixated on an $88,000 price point, even though the house, we'll call it, the fair appraisal was $78,000. So imagine if you paid $78,000 for it and you got a loan on it, whether it was 2%, 4%, 6%, or whatever. At some point, you'll be paying more than $88,000 for that house, right? Because the interest that you're paying on it. But at 0%, you can go up a little bit higher and pay that much for it, and it would look like you're paying more for it, but in the long run, with the financial numbers, you won't be paying that much for it. Does that make sense? So if you had a 6% loan at $78,000, how many years would it take you to where you're paying more than $88,000 for that house, as opposed to having a 0% loan at $88,000, and then seeing where that point. So I should probably do that math for you guys to let you see that. But it's pretty neat how you can overpay for something as long as you get the terms that are in your favor. You're really not overpaying for it. It's just you're just using the advanced techniques of understanding compounding interest, right? So Edward said, is the 3 rule different if you are selling to investors? Yeah, the idea about the 3 rule is, if, number one, is it a single family owner occupied situation? If it's a non-owner occupied situation, then the rules don't really apply to what we're talking about. You still, want to go through underwriting because that's the right thing to do, but the rules don't apply to that. So it's single family and it's owner occupied homes as being the seller financier. That makes sense, Edward. 3 rule, whether it's a note or CFD. Right. So the 3 rule, whether it's a note or CFD, correct. CFD stands for contract for deed or land contract, agreement for deed, contract for real estate purchase. Those are all the same. They're all kind of the same thing. They're just a security instrument that secures the house. So yeah, it's just 3 seller finance transactions. It doesn't matter if it's note, mortgage, deed of trust, contract for deed, CFD. And it looks like I lost power to the area here. All right. So let's see here. Yep. So I answered your question. All right, cool. Those are good questions tonight. Keep them coming. I like this. Oh, I think I know why the lights went off is because I'm not moving. Maybe if I can just wave my hands, the lights will kick back on, or not. I think I got a light here. All right, Dave asked a good question. How many years do you typically create the CFD for? That's a good question. I guess it depends on either the exit strategy, which is typically when can I sell this note and how can I sell it for the most premium I get for it, right? Because the idea is to not take much of a discount when you're selling your loan. When we buy a loan, we obviously want to buy with as much discount as we can, right? Because that's in our favor. But when we sell a loan, we don't want to give up a lot of principal if we can help it. So just, Dave, I know you've done this stuff before. Creating a note and mortgage makes it way stronger than a contract for deed of land contract, number one. Number two, having it underwritten with a third-party underwriter makes it another level stronger. And then number three, having it serviced by a third-party professional servicer makes it as strong as it can be. Getting, sizable down payments, and just having a solid. So to answer your question, it really depends. On a $20,000 loan, it's probably going to be the shorter AM, probably 6, 10, maybe 12 years, depending on it. Bigger loans, 40, 50, 60, 70, 80, they'll probably stretched out to 10, 12, 15 years. 80 to 100, 150,000 will probably go on 20 years, and beyond that, it's going to be 30 years pretty easily, or splitting it up into two notes, making 80% of value one note and 10 or 20% of the other part of that be the second mortgage on that. So I typically look at deals that are probably under $100,000 pretty commonly. And what I like to do is I like to look at the rent data in the area. So if it's let's just say a $900 rent payment, let's call a $1,000 rent payment a month, and taxes and insurance are about $200. So your net income is going to be $800. So I focus on that payment being the principal interest being just about $800 or below $800, and I'll work backwards from there, and I'll make sure that the interest rate is in favor of me and not too outlandish, and I'll kind of work backwards from there if that makes sense. So that's kind of how we get it. But it ends up being, Dave, like the lower the unpaid balance, obviously the term's going to be a little bit shorter as well. Now, if you end up having a $150 payment and you got a $40,000 note, I mean, that's just going to be a very long amortization. It may be 40 years on that. So we don't really do that. But that's kind of what I go after, Dave, if that answers your question. With CFDs, yes. So Dave asked a good question. Have you ever sold partials with CFDs? And the answer is yes, we have. It's no different than a note and mortgage. We just make sure the partials that we sell have very strong borrowers in there. We definitely want to protect our partial investors because they're very important. The reason why they invest in this stuff is because they may be getting a lower return, but they have extremely low risk in the deal because they're only buying into a part of it. So I think we may get into some partials in future note meetups that we have. Does that answer your question, Dave? Yeah. All right. Got that stuff. All right. We answered that one live. Good questions tonight. So that was kind of what I had for the presentation today, just talking about the 10-year model, just watching the growth of that, and then looking at this, what I call this gap funding deal, having a creative second, having the seller carry the creative second for you. And then this guy knew that he had a gem. He had a property that he didn't have to put a whole lot into, so to speak. Now, $20,000 is a lot of money, but in the grand scheme of things, $20,000 is a very low rehab cost for stuff as well. So I was surprised by the ARV, but he runs his numbers pretty tight. So, cool. Thanks, Dave. All right, Lewis asked a good question here. Why do partial versus collateral assignment loan against the note? Okay. Either way is fine. Hypothecation is wonderful. It can work different ways. What I like about partials is that I can be in a deal and pay a certain price for it. I can resell that deal, get all of my money back with a little bit of profit up front sometimes, and then have that back end be kind of free wealth in the future, right? And those are great plays for my self-directed retirement account. The collateral assignment would be kind of like a hypothecation. So for those of you on the call that may not understand this, so a collateral assignment is basically where I have this loan that I have that I want to sell, like on my website, but I want to actually get a loan against my loan. If that makes sense. So the hypothecation theory, and this is what banks do all the time, but in much grander scales on portfolios. So I take this cash flowing asset, just like having a rental. If I have a rental that cash flows, blah, 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 and the bank, I want to leverage that and get money against it from the bank, kind of like the Burr method, the Burr method, right? B, continuous R. So I have this $100,000 rental and the bank says, yeah, we'll lend you 60% of the value of this rental. Okay, fine. So then I go out and I get $60,000 and the collateral for the bank is this $100,000 rental, right? So it's the same thing with notes, with collateral assignments or hypothecations, to where you pledge these assets to a bank or a private lender and you say, here's the value of these assets, here's the cash flow, and I want to borrow 60% of that. I just say 60% because 70 and 75% usually gets a little risky for banks and private lenders that we've worked with before. And so that's kind of what I've seen on that. So hopefully that answers your question on the first part. Awesome. Second part of your question, Lewis, is it would be tax-free to get a loan versus selling a partial. So it depends. So if you're buying a loan in your self-directed IRA and you sell a partial in your self-directed Roth IRA account, there are no tax implications, right? Because it's a Roth account. So this can kind of get into the weeds. So we would probably want to have like a CPA or a tax person answer the question. So I wouldn't feel right answering that question 100% because I'm not following it that closely. So if you did this all in your retirement account, then obviously that's one thing to do it. If you did this outside of your retirement account, there will be some tax implications for it, like capital gains after a while, or the capital gains is hidden inside each payment that you're really paying each month with taxation. So it can get into the weeds, but at the end of the day, you're going to be able to lower your tax liability in notes a lot better than real property, because notes, you're getting a stream of income slowly every month, right? And so that's what lowers your tax liability. So it's not like getting W-2 income, or it's not like getting a big capital gain. It's slowly trickling in. So it's what I consider it as treating it as portfolio income, and that's the taxation on it. Awesome. All right, got that covered. Let's see if I missed anything on here. You guys are doing a good job blowing up the chat board. I appreciate that. I like that. All right. If anybody has a question they want to go and speak live on, I'm more than happy to unmute you now. We're to the tail end of the conversation, so let me go ahead and advance to the next slide in case you guys have more questions. We'll definitely stay on a little bit longer. So our next note meetup will be Wednesday, September 9th, 6 to 8 p.m. I would love to have this thing live and have people here in person and stream Zoom again like we did last month, but I'm probably sure we're going to be doing just Zoom only again. But either way, you guys are more than welcome to hop on. Even if we are live, I'm still going to stream it by Zoom, so that'll be just fine. But follow us on social media if you want. We do have a Facebook group that we just started that we're trying to build up. It's called Be the Bank Real Estate Note Investing. It has that picture in the background, this Be the Bank picture. And so you can go to our Facebook group and sign up. It's like any other note group out there for Facebook group. We just, if people are just looking for help, that's the main idea, is just trying to help people out, understand the note business, where to go, who to ask questions to. We had a real good case study on there before. I promote the meetup on there and stuff, so you guys are aware of it. And it's just a way to stay connected. There's 3 other note investors that I have on there that help moderate questions and stuff. So if I can't answer it, one of the other guys that have been in the business for a while as well can answer it. And so it's not something that we advertise stuff. If you have deals that you want to sell or buy, that's, more the merrier. We're okay with that, but we definitely don't want people selling product or services. We want to refer business to the people that we all trust, like, and know. So. Yep. All right. So feel free to keep plugging in questions out here. We will go ahead and kind of end the recording of this, but stay on if you want to. We're still going to stay on, but we're going to end the recording of this right now. So for those of you that are watching the recording of this, we're going to see you next time. We like to keep this thing to about an hour on the recording part. For those of you that want to stay on, go ahead and stay on, and we will end it. So.